So it is hot out there for sure, but also hot in terms of what's going on in the economy, the markets, and the headlines. So we thought on this week's program of Dollars and Cents, we would spend some time breaking down each of those topics for you by looking at some of the most recent economic data and then also going out on the proverbial limb and share with you what we would expect to happen during the course of the rest of this year, 2025, based on where we are with all of these tea leaves floating around out there involving the economy, the markets, corporate America, and the headlines. Plus, we're going to have more this week on the One Big Beautiful Bill Act. There's no shortage of discussion on this thing. I mean, 900 pages, right? So we're gonna look specifically at like four different things: the Trump accounts, the no tax on tips, the no tax on overtime, and the car loan deduction. Those are the four things we're really going to kind of really dig into significantly here on this week's program so that you can have a better understanding of how all of that works. Frankly, given the details on each of those different topics, you could probably do a whole show on each one separately. We're going to try and knock out four of them on this week's program. So welcome on into the show. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations along with a variety of podcast platforms. Any trouble finding our program, go to our website at nelsonfinancialplanning.com. There you'll see the icons. Click on them. They'll connect you to the channels on those platforms. Once there, make sure you subscribe, of course. You don't have to do that exercise again. And if you find something that you like, we encourage you to, as always, hit that like button. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well. They stand ready to help you make better sense out of your finances. So it is certainly hot here in the middle of August. If you're new to Central Florida, this is pretty much what it looks like every year. Speaking of kind of things that happen uniquely here in Florida in August, school actually starts tomorrow. The air date of this program is August the 10th. Lo and behold, tomorrow, Monday, August 11th, school starts for most of the counties in this area. So I guess be forewarned, probably commute times. Usually when school starts back up, you see commute times going up a little bit. So make sure you plan on an extra few minutes tomorrow to get into work on time. Of course, the start of school means that we are in the midst of our annual school supply drive at the office at Nelson Financial Planning in beautiful Winter Park, Florida. We do that drive every summer. It runs from July 1 to September 1. So we accept obviously donations of new school supplies of pretty much any kind, all of which benefit both Orange County and Seminole County students. And so we encourage you to participate in that. Also collecting used electronics as well as part of that. Also here in the month of August with the back to school sales and specifically the sales tax holiday here in Florida that runs for the entire month of August. So you've got an opportunity to purchase various school related items without having to pay any sales tax. So some of the items that you can purchase without having to pay a sales tax include things like clothing, footwear, wallets, handbags, backpacks, things like that. The sales price got to be $100 or less per item. So, don't get your kid a Toomey backpack, or frankly, you probably shouldn't do that anyway for a variety of more financial management and perspective reasons than that. But no sales tax if that object is over or no exemption from sales tax if that object is over $100. Certain school supplies with sales price of $50 or less per item. And then, of course, personal computers. This is kind of the big one. I think there's a number of folks out there who kind of wait till August, whether you've got kids or not, because you can get a computer, assuming the sales price less than $1,500. No sales tax on that as a result of the sales tax holiday here in Florida. So, bit of a savings there, right? If you're in Orange County, sales tax 6.5%. Across the line in Seminole County, it's 7%. So, some degree of savings. That's always a good thing for your wallet. What's not pretty for your wallet these days is the cost of health insurance. Came across this statistic courtesy of the Kaiser Family Foundation, and this one was sort of surprising. Here's the stat to help it put it into perspective. The average annual cost for family health insurance coverage increased 297%, let's call it 300 for the purposes of this conversation, from $6,400 per year in the year 2000 to $25,570 in the year 2024. That's the annual cost for family health insurance coverage. That basically translates to an inflationary rate of close to 6%. Meanwhile, the regular inflation rate is at 2%. So some pretty dramatic numbers. And certainly a big part of making sure that you now really line item include that in your financial plan, particularly as you're approaching retirement, thinking about going into retirement. These are big numbers, folks, and you've really got to make sure they're part of the equation. That stat sort of goes hand in hand with the other stat that I saw this past week involving the composition of the economy, or should I say the jobs in the economy. This comes to us courtesy of New York Times. In 2024, healthcare was the largest employer of any economic sector in 38 out of 50 states. So in 38 out of 50 states, okay, healthcare, the largest sector, employing the most amount of people. That's, 40, that's almost close to 80%, certainly over 75%. So 75% largest employer, largest sector was healthcare. While manufacturing, flip side, was the dominant sector in just 6 states. If we think all the way back to 1990, so that was 35 years ago, the manufacturing sector was the dominant employer in 35 states, and healthcare wasn't the top employer in any state in the union in 1990. Pretty amazing, right? And some interesting stats when you start to think about the cost of healthcare and how important it is to make sure it is part of your budget, part of your overall financial plan. When we think about those costs, they certainly have gone up dramatically. 300% increase just from the year 2000, from a total annual cost of $6,400 to an annual cost of over $25,000 here in the year 2024. So basically going from $500 a month roughly to over $2,000 a month. For many people, that can almost be the size of a mortgage. So important to really put that into the planning. And obviously, that increase in cost, with that much increase in cost, that means there's money to be made, and that's where the sector or the economic activity has certainly followed. When you consider that healthcare is now the largest employer of any economic sector in 38 out of 50 states, and in 1990, it wasn't the largest employer of any economic sector in any state all the way back then. So interesting stuff. We will continue. We got more interesting stuff here on Dollars and Cents coming up after these messages. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents. On the program, we're talking through a little bit about, in this segment, a little bit about kind of where we are and sort of taking stock at kind of where things are, because, you know, it's August, and oftentimes I think August has a reputation where, hey, it's still kind of summer, although here in Florida it's not because school starts Monday. But anyway, for the most of the rest of the country, it's particularly in the Northeast, August still means summer. And typically, you know, people travel on vacation, and you may be thinking, well, you know, there's probably not a whole lot going on economically or things that I necessarily have to pay attention to because everybody's on vacation. Everybody's kind of in vacation mode and having fun and not really kind of focused on what economic activity may be happening out there. And the reality is right now it's quite the contrary. In particular, over the course of the past couple of weeks, there's been a sort of a rash of economic and market and corporate America and headline type of news, all of which, as you might suspect, are important and certainly intertwined with each other. So in this segment, we're going to kind of break down each of those and sort of see how they might impact each other. And of course, most importantly, how they might be able to impact you, your finances, and your investments. So we'll start with the most recent economic data, which, if you missed the headline, it wasn't particularly good. Data is certainly not good. When the head of the government entity that produces the data then gets fired because the data is that bad, that would be data that's not particularly strong. So behind that, of course, is the unemployment rate and the job growth data. So what happened is that job growth has effectively started to slip, at least according to the Bureau of Labor Statistics. And the unemployment rate pushed up to 4.2% from 4.1% at the beginning of the month. But perhaps more troubling, and this is the piece that I think probably cost the head of the Bureau of Labor Statistics to lose their job, is that job growth for the prior 2 months, so May and June, because the data that was announced was for July. When they made the announcement of the jobs data for July, they also said, oh, okay, we need to revise the May and June data as well. And folks, that's normal, okay? That's the normal sequence and the pattern of this. But what caught everybody by surprise is just how much those numbers were revised lower. So it actually, because of those revisions to May and June, it actually put the 3-month average for private job growth at about 52,000. Now, to put it into perspective, back in February, that number was 158,000. And in fact, that is the lowest number since last August. So clearly there's something going on in the labor markets and the labor statistics. I think part of that silent, unspoken message, which is certainly hard to kind of see in the actual economic data as it relates to the people working, is that AI is probably still probably in there and causing employers to maybe not hire quite as much or not replace people quite as quickly as they might otherwise have done that. Certainly the impact of AI is certainly beginning to really make itself known in the workforce, and more employers are finding that maybe we can use this and not necessarily have to have the same amount of staffing as we once had. So a lot of stuff going on when we think about the unemployment data and the labor data. The reality is that what was interesting about the labor data when it came out is it came out at the 1st of August, and it actually kind of was a little bit of poor timing in that the Fed meeting had just concluded 2 days prior to that, and at that meeting they said, everything looks okay enough, that we're not going to make a move when it comes to interest rates. So they said, okay, we're going to hold off, not change interest rates. And then lo and behold, 2 days later, the unemployment data came out and it showed, a bit of weakness on it. So what's interesting about that and why we mention that is that almost a repeat of what we saw last summer as well. The exact same scenario, if you think back to last year, happened where the Fed met in June of last year and held rates steady, only to have subsequent unemployment data come out showing sort of an unexpected cooling. The Fed then sort of was forced to make up for this June inactivity by cutting rates, not just the usual 0.25 or quarter point, but actually a full 0.5% rate cut in September of last year. So we will see whether history repeats itself. Certainly, these look to be very similar in terms of sequence. The one thing, of course, you got to watch out for, and we've certainly said this many times over the course of the past few weeks, is that be careful what you wish for. If the Fed's cutting rates, that may be great if you're looking to borrow money, but not so great if you've got cash and money market savings. As we've seen, just while the Fed has been cutting rates of late, those interest rates have gone from 5% down to 4%, or although in a lot of cases I think they're under 4 now. If the Fed cuts rates more between now and the end of the year, which I think that's widely expected, you could very well see those interest rates on your money markets and your cash accounts being under 3. And then at that point, you're not really staying ahead of inflation. So that may force you to kind of think about making some different investment decisions. So that's where the economic data, the unemployment data is. That's where the Fed is at. We will shift now to sort of where the markets are at, because this is kind of the unique thing where we see the markets continuing to kind of perform. And a big barometer on that is just how well corporate America is doing. They continue to make good money. Maybe this is also the AI theme in there as well. Again, you can make good profit if you can reduce down your single largest expense as a business, which often for most businesses is the employee cost. So if you're reducing that, then you're keeping your profit up. But the reality is that through the first of this month, there was a total of 317 companies in the S&P 500 that had reported earnings for the second quarter. So this is earnings season right now, what we're in right now. Companies are reporting their earnings for the period of April, May, June of this year. Well, at the beginning of the month, over 60% had reported. 83% had, with those reports of earnings, 83% beat analysts' profit forecasts, and sales results in the aggregate wound up beating estimates by 2.6%. Causing earnings to come in at 8.3% higher than expectations. So, folks, those are pretty good numbers when we think about where things are in terms of corporate America. So, particularly as the second quarter earnings season continues to kind of unfold, we turn now, I guess, to the last part of kind of the tea leaves floating around out there, and that would be the headlines. Yes, clearly there's on and off tariffs, that is for sure, and certainly a host of global hotspots, particularly in the Middle East. But the big development last month was obviously the one big, beautiful bill, and there's some specific aspects of that we're going to talk about in the next segment that really are going to be, in our view, some pretty significant economic contributors to what's happening out there. So stay tuned with us through the break, and we're going to kind of continue this conversation, kind of looking at the tea leaves out there and seeing what's happening in the world at large. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're talking about kind of looking at the different tea leaves that are floating around out there. You got the economic data, the unemployment data that came out at the beginning of the month, weaker than expected, definitely weaker than expected because it wound up having somebody lose their job, especially when they revised downward the numbers for May and June. You've got the Fed, which sat on its hands in June. Next meeting coming up is September. Expect them to act or react to what this labor data showed. Be careful what you wish for, though, on that. If they cut rates, that means your money market, your cash savings rates are probably going to go down as well, or not probably, will. So you might need to start to look for different options, particularly from an investment perspective on that. Roll in corporate earnings season, which is ongoing, but through the first of this month, over 60% of companies had reported. The vast majority, 83%, beat expectations or beat analysts' profit forecasts. Obviously, that's a sign that, yes, in fact, corporate America is still kind of navigating through some of these headlines in terms of the tariff policies or the uncertainty involving the tariff policies. They're on one time, they're off the next. And then, of course, these global hotspots that are, throughout the world, I guess specifically focused kind of in that Middle East area. The reality is that despite that, corporate America continues to do pretty well, or at least based on these earnings announcements or this earnings seasons that's ongoing here for the second quarter, which would be the period April, May, June of this year. The other big development to talk about kind of most recent headlines, of course, is that there was a big tax bill passed. The One Big Beautiful Bill Act was passed last month, and we're going to get into some of the specific provisions here in just a minute, but it also had a lot of provisions in there that really helped companies beyond sort of giving clarity on individual tax rates, which was obviously a major part of what it did. It also had some relatively pro-growth components for corporate America, particularly some of the changes allowing for upfront depreciation of assets, immediate expensing of research and development. Those are pretty significant when we think about the windfall that then inures to a company if they're able to write off all of the cost of certain assets rather than having to write that cost off over time. And in fact, already producing some windfalls in corporate America. Early estimates of the impact of the ability to kind of use more of these upfront expensing is that coming in at $148 billion in cash tax savings, which is the equivalent of 8.5% of the company's combined full-year estimates for free cash flow. So, got businesses sitting with money doing okay. Now it comes along a tax bill that further pushes that forward. So how's that all shake out for the rest of the year? Well, here's where we say stay tuned for future episodes of Dollars and Cents. We do it every week. But here's our thinking. And it's interesting when we think about the beginning of the year. Obviously, at the beginning of the year, we do a fearless forecast. It's something we've been doing every year for decades now. And so our fearless forecast for the Dow was 45,000, that the year would end at around the Dow being roughly 45,000. We're at around 44. So we're kind of on track for that. And we think that there's a powerful combination going on that should Trump or offset, we'll go with the impact of maybe some of the political uncertainty involving tariffs or some of the global hotspots, things like that. The reality is you're probably going to have lower between now and the end of the year. You're probably going to have interest rates that are lower than at the end of the year than where they are today. Corporate profitability will continue, particularly if you've got a a tax bill that encourages spending and expensing upfront of things like depreciation and research and development. And so we think that those two factors will be a major impact on helping the markets to kind of continue to move forward between now and the rest of the year. Of course, y'all know the real bottom line, right? If you're a regular listener to the program, you know this. Be diversified, be consistent. Those are obviously two fundamental principles when it comes to investing. And then, thinking back to last week's show, we would also, of course, emphasize, as we do on a regular basis on the program, make sure you know what you own. Know what you own and make sure that it is quality companies that represent different industries from different parts of the world. Far too often, there's way too much concentration going on out there, which means that that undermines the diversification of your investment portfolio. So speaking of the one big beautiful bill, we wanted to kind of break down four pieces of it. Obviously, in prior programs, I think there was one that Zach and Christina did, and then there was one that I did, where we kind of scratched the surface a little bit. But as you might imagine, there's 900 pages in this thing, so there's a little bit more than just what you can get off in a segment of a radio program. So I thought it would be good if we spent a little bit of time digging down into some of the parts, and then in some future programs, we'll kind of dig into some of the other parts as well. So on today's program, we're going to talk about the Trump accounts, we're going to talk about no tax on tips, we're going to talk about no tax on overtime, and we're going to talk about the car loan deduction thing, along with the pitfalls that you need to be aware of, right? Because these are some pitfalls in terms of how these actually work or who gets to claim them and under what circumstances. So we'll start with the car loan deduction. This is an additional deduction based on the interest that you have or that you would be paying as part of that car loan. And so it's a deduction that goes up to $10,000, that if you have a car loan, there's interest, and you're allowed to take the interest component of that and write that off as an additional deduction. Here's the kicker, regardless of whether you itemize. So if you take the standard deduction, this is going to be another additional deduction that you can take on top of it. So pretty powerful in terms of its availability, but here's what you need to know. First of all, it's only good for 25, 26, 27, and 28. That's it. And then it goes away. Second, it must be a personal passenger vehicle, less than 14,000 pounds. It can't be a big giant, truck or something like that. It's got to be a passenger vehicle. And so along with that, it's got to be a brand new car. This doesn't apply to used cars. And the final assembly of said car must be in the U.S. So understand the parameters. It's got to be a personal passenger vehicle less than 14,000 pounds. It's got to be brand new, brand spanking new, and the final assembly has got to be in the U.S. So it's not every car that this thing's going to apply to. It is just those cars in particular. Now, the more money you make, the less likely you are to get this additional deduction. If you're single and making above 100,000, or on a joint return above 200,000, that's where the phase out starts to happen. And those phase outs happen pretty quickly. You would lose $200 of this deduction for every $1,000 you're over that 100,000 as a single limit, 200,000 as a joint limit. So, I guess it's good if you meet those income parameters, but in order to use the full $10,000 deduction, you'd need like a $125,000 car loan at 8%. Let me be very clear. We're not recommending that because that's a big car loan at a big interest rate. So might get some benefit out of this one, but not as much as you might think. With that, we're going to take a break and continue on here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So going through some of the details on some of these different provisions that you've heard a lot about that came about as a result of the one big beautiful tax bill. We certainly covered a lot of highlights in previous episodes of this program over the course of the past few weeks. We're digging a little deeper into it, and particularly before the break, we were talking about that car loan deduction. It is the good side of it is that it is an additional deduction regardless of whether you itemize or not. You don't need to itemize your deductions. You can take the standard deduction and then get this deduction for the car loan interest on top of it. So that's kind of cool. The negative side is that it is only available if your income is below certain thresholds, $100,000 if you're single, $200,000 if it's a married return. If you're above that, it starts to phase out pretty quickly. $200 of that deduction phases out for every $1,000 you're above those limits. So it phases out pretty quickly. The other part of it is you got to buy the right car. It's got to be a passenger vehicle less than 14,000 pounds. It's got to be brand new, and it's got to be a final assembly in the U.S. Only available for 25 through 28 tax years. And then the practicality of it, as we were saying before the break, in order to maximize the deduction, which is a $10,000 deduction, you'd need to borrow $125,000. You'd need to, borrow $125,000 at 8% in order to maximize out the deduction. Let me be very clear: there ain't no deduction worth borrowing $125,000 at 8%. So perhaps make sure you make a good decision on that if you're looking to try and maximize that deduction. I might hold off on maximizing that one. That might not make the best amount of sense to borrow $125,000 for a car. Perhaps there might be something a little bit more economical on that, particularly if you really do qualify for it and you're making less than $200,000 as a married couple. Yeah, you probably shouldn't have that kind of car in the first place. But anyway, I digress. Next up, no tax on tips. So this one, a lot of conversation about. Again, this one good for tax years 25, 26, 27, 28. It applies to you regardless of whether you are on a W-2 or whether you are 1099, whether you're getting sort of self-employment income. It requires you, of course, to report all your tips, which you kind of should be doing anyway, but probably most people don't. Those tips are still subject to FICA taxes, Medicare, Social Security tax. That alone is almost 8%, 7.65% specifically. If you provide specialized services, and this would include even a technician or a plumber or something like that, then no, if you get a tip, no, that you're going to have to pay full freight on that. The no tax on tips exception does not apply to that. The deduction. So once again, this is another deduction. The deduction is $12,500 per person. So if you're on a married return, you could actually get a deduction of $25,000 out of this. But again, you've got to have the right income. In this case, your income as a single person has got to be less than $150,000. If you're doing a joint return, it's got to be less than $300,000. If you're above that, then there's again a phase out for $100 for every $1,000 you are above the thresholds. By the way, as a side note, whenever you're kind of working these phase outs and how this all works, and if you're trying to take advantage of this stuff, please use some kind of a professional tax software or professional tax preparer, because if you're trying to do this by hand, you're probably going to mess it up. Because there's a lot of math involved and a lot of behind the scenes calculations. So just a little caveat there. Here's the real thing that you need to know. On this deduction for no tax on tips, it is completely disallowed if you file on a married filing separate basis. So be careful, that at the end of the day, that you don't lose it if you have that married filing separate tax status. Bottom line on this one, obviously, it'll work. It'll save folks money, assuming that they kind of fit the box, that they're not getting tipped in a specialized service type of capacity. that they realize that the tips are still going to be subject to the FICA taxes, the Medicare, and the Social Security, and got to report all of the tips in and of themselves. You're going to get a deduction for those tips, but you've got to make sure that you qualify from an income perspective. So again, some things to know when it comes to, hey, I get tip income and I'm not going to have to pay taxes on it. You got to make sure that you fit. Once again, you got to fit the box in order to be eligible for this one. Same thing on the tax on overtime. So all of these are, again, tax years 25 to 28. And this one, the no tax on overtime, only applies if you're W-2, so not 1099 like the no tax on tips, and only applies if you are hourly. So know that that is a big distinction on this no tax on overtime. Of course, it's still going to be subject, this income may be income tax exempt, but it's still going to be subject to FICA taxes, the Medicare, Social Security. The deduction, just like the no tax on tips, the no tax on overtime, it's still a $12,500 deduction. If you're married filing joint, that $12,500 is per person, so you could go up to $25,000. Similar phase out, $100. You lose $100 for every $1,000 you're over that $150,000 limit as a single person, that $300,000 as a married filing joint. It is, just like the no tax on tips, disallowed if you are married filing separately. So make sure that you are aware of that limitation. It also, and interestingly, this is again where the calculation kind of gets wonky. This no tax on overtime only applies to the overtime portion of the wages. So let me give you an example on this. So let's say you make $20 an hour and you work 10 hours of overtime. So that 10 hours of overtime wages, 1.5. Now you're going to get $30 per hour for those 10 hours of overtime. The portion that is no tax is that extra amount, that extra $10, the overtime piece that you are earning, and not the entire amount. So again, if you're making $20 an hour and you do some overtime, and then for those overtime hours you get $30 an hour at your traditional 1.5 times for overtime, then it's only the half, if you will, the excess amount that is eligible for this no tax on overtime. Yes, if you're listening there and thinking, well, that's kind of very specific, that would be correct. These are not things that you can just kind of wave your hands at and all of a sudden you've got it all figured out. There's a lot of nuances in terms of how these things play out, particularly when you start to look at that no tax on overtime and the additional calculation you've got to make, because the no tax on overtime only applies to sort of the extra amount that you get on those hours that you work on an overtime basis. So just be aware of that. And then lastly, the Trump accounts, and we may have to circle back on this one. 25 to 28, got to be a U.S. citizen with a Social Security number. If you're for every newborn, it's $1,000 put into that account by the federal government. It has to be invested in basically index funds. That's the limitation on it. You can contribute up to $5,000. Your employer could also do $2,500. But here's the kicker. Those contributions are done on a post-tax basis. So you do not save any money when you make a contribution into a Trump account. More importantly, when the money gets used, and it looks and acts a little bit like a retirement account here, because you can't use the money before 59.5 without a 10% penalty. It's taxed at ordinary income tax rate. So just understand how it works. You put the money in post-tax, so after tax. So think that sounds like that's a Roth, right? Well, no. The Roth, you would get that money back tax-free. With the Trump account, when you get that money, you still have to pay taxes on it. So there is a lot of wrinkles when it comes to this Trump account. We're going to be talking more about it in greater depth on future shows, but just understand that that's how it works. The main incentive, look, take the personal savings component, the $1,000 that the federal government's going to give to that newborn if you have one between now and 2028. But I think there's better opportunities in terms of how to save your money. With that, we're going to get on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.